All right, Lobo. Part three of this, how to pick mining stocks like a wolf series or whatever it might be called. And I'm hoping we can talk about what you call the greatest discovery of your career, the PPSS, which stands short for pre-production sweet spot. What I understand of that this is sort of a framework that promises or no has studied past returns, and it shows 92 to 95% odds of success, with the average gain of these being almost 100%, with the possibility, important word here, to bag 750% on the top performance, which all sounds almost too good to be true. And I feel like a late night infomercial actor. So what's going on? What is this? Is it real? How does it work? How do you know about it?
Okay, so first let's frame this. We've been following the Lassonde Curve, right? Discovery, boring engineering phase, and then the ramp up to production. So the PPSS is that ramp up to production. It's the final hurrah of the Lassonde Curve before you get to the difficult question of, was this all worth it at all? Which is maybe, a point worth stressing when you, and this is part of the answer to your question. The basic idea is that, your junior explorer makes a transition from almost literally pouring money into holes in the ground, right, as you're drilling, to taking money out of a great big hole in the ground as you're mining, hopefully. And obviously that transition from pouring money into the ground and getting money out of the ground is worth a market re-rate. This was known, this was actually conventional wisdom. I didn't come up with the phrase pre-production sweet spot. That's what it was called when I got here almost 20 years ago. But it was also assumed to be priced in. Everybody can see who's building a mine. It's not something one does in secret. It's something that's announced, and there's all this permitting and studying and so on. So everybody knows who's going to build their first mine. And it was assumed that the gains in that period would be priced in or modest. And to my knowledge, my claim to fame here in this space, this is the thing that Rick Rule has said, it's his view that this is the best thing I've done. It's the highlight of my career. And he's even assigned people in his shop to invest accordingly, or research and invest accordingly. This was the famous, I've reviewed your work and I could find no flaw, which was high praise to me coming from the loan shark of Rick Rule. I could find no flaw. I was like walking on clouds that whole week. But anyway, so my claim to fame was that as far as I know, I'm the first one to actually measure this thing. And there's a very bright young fellow led this research initially back in my Casey days. And after the appropriate hands-off period, I've been able to hire the same fellow back to work for me now at the Independent Speculators. I'm very glad to have him on board. His name is Konstantin. He's one of the nicer Russians, if you want to look at it that way. He's brilliant, he's motivated, he's really smart. And he first put these numbers together, I think it was 2017 or so. And I just asked him, well, so we have this pre-production sweet spot, everybody talks about it, but what is the actual gain? Like, everybody just assumed it wasn't much, but what was it? You ask him, well, I don't know, it's something, Doug Casey, his guess was maybe 20%. So Konstantin went and found a couple dozen examples and then came back, and the average gain was like 140% from a construction decision to first pour or first production. And I said, that can't be right. That's way too high. Go look for more. I think his first round was like a couple dozen examples, like 20 or 25. And then he came back with 45 or 50 or something like that with a very similar response. It was lower. It was like 115 or something. Speaking of memory. So that was a lot. If you think about it, okay, everybody knows who's building their first mine, but how many do you know that are building their first mine right now? You can count them on one hand. This isn't something that dozens of companies happen to do every year. So, a data set of 50 is that it's not like I'm extrapolating to the universe, the entire universe of these cases from a very small sample and using statistical means to guesstimate what the total universe is like. 45 is a lot of these companies. And the answer was robust. And I remember telling Doug about this, and he couldn't believe it. We did more research and we kept finding the same answer. And it's now, the larger the data set has gotten, it's settled to about 100% gains. The other key findings were as you pointed out, most companies that they start to build their mine, they succeed at it. Like if you think about it, you know, the bank lends you money, you do all these engineering studies. It makes sense that you're not going to start building your mine unless you're pretty sure you're going to be able to do it. And most of them do. So, but there's caveats here. Obviously, if you do this during a bull market, the average gain is higher. If you do it during a bear market, the gain is lower. But actually, the average, even in a bear market, is still positive. That transition from burning money to making money is so significant that even companies that made this transition during what we identify as bear markets had on average like 25 to 30% positive gains. That was the average. Of course, some failed, some didn't. You know, there's still risk here. Some companies won't succeed in building the mine. An endangered mosquito will be discovered on the property or whatever happens, right? Or they fail. But the finding is quite robust. And our data set now is up to like 140 cases or something like that over the last 30, 35 years or so. And if you think about it, if there's only a handful every year and we have 100 and whatever cases it is, we have most of them. So I'm not just estimating. I haven't asked 5% of the population and then drawn conclusion about 100% of the population from that statistical sample. We have most of the cases. I mean, I don't know if it's 95%, maybe we have 90%, maybe there's a few of them that we've missed over the years, but we have, I can confidently say we have most of them. And so we actually understand this population. So now it's still a relatively small data set. It's not like we have thousands and thousands that you can do much more robust statistics on. But on the other hand, it's not really just a small sample. It's the actual data. Like we have most of it. We know about almost all of these cases. And that finding of about a double between deciding to build your mine and flipping the thing on to see what happens is still there. So where I started to diverge from this is that the end of the process is interesting, because when you flip that switch, now you find out if that feasibility study was any good, if you had rosy assumptions, if you have any surprises in the geology underground. There's a lot that can go wrong. Our data shows, though, that from that first production to declaring commercial production, there's still on average a slight increase, but it takes a lot longer and it's a lot riskier. So to not go on too long about this, the main beauties of this, in my mind, are that it's easily identifiable. It has clear entry and exit points. It's not just like, you know, oh, subscribe to my newsletter and I'll tell you when it's safe to buy and when you have to sell, right? Anybody can do this, right? There are clear entry and exit points, construction decision, or, you know, some companies, they don't formally announce it. They just start doing it. And you can see from the press release, you know, we go back in our data, and if they don't make a formal board announcement, we'll look at when shovels hit dirt, obviously, and then we'll count that press release as the construction decision. And then first pour or commercial production gives you your exits. So it's a very simple and clear strategy. The data is very compelling. I don't give the data away. I have been asked, but, you know, I've spent years now compiling this data and it's useful. But others have now replicated this research, including Master Rule, and could find no flaw. So I feel very confident in this. You probably have a bunch of questions, but let me just say also, though, that doesn't mean you can do this with your eyes shut. It's not that simple. And there have been counterexamples. Recently, for example, I'm not recommending for or against the company, but I'll just give it as an interesting contrary example, was Silvercrest, which has a big high-grade silver mine. It seemed to have all the right characteristics to really go nuts in the PPSS, you know, soar as a high performer. And it really sort of traded sideways throughout the PPSS. My explanation for this is that, and this is just a theory, like I can't prove this. It's just I'm looking at it and I'm trying to understand what happened. My explanation is that it was so high profile, it was so high grade, you know, kilos per ton of silver, big, you know, they keep finding more veins, all these wonderful things, right? I think it got front run. And maybe I shot myself in the foot a little bit about it. People know about the PPSS. People saw this prime example. And that thing, it ran up a lot to the construction decision. Like it was obvious they were going to build this mine. And there was a big ramp up before it officially became a PPSS play. And then afterwards, it kind of traded sideways. So it was a matter of sort of living up to the expectation by the time they reached first pour. So that's one contrary example. We've had a couple in mine builds recently completed that have been great examples, have delivered high gains. One of them in the uranium space that I'm not going to mention, but people can figure it out, right? Have done terrifically well for shareholders who bet on that company building the mine successfully. So the premise is alive and well. It's easy for anybody to identify and jump in on, but I still think due diligence matters. You want to pick the better ones, and I'm still working on the idea of there's a handful of really top performers. There's like a half a dozen stocks that really had that caveat with your intro, right? It could, but maybe not will produce 700%. That like there's just this handful that had that really high return on the order of a discovery. And I've been working for years actually on trying to figure out what causes that, because it's nothing obvious. I have a new theory that I'm testing now, so it's an exciting time for me. Basically, what I'm trying to say, Antonio, is that the method works. Yes, you can do this at home, but there are nuances here, and I'm hoping that I haven't talked myself out of a job, because I'm still working on and improving my track record on this.
Right, but that last part is very important, and I do indeed have a bunch of questions regarding valuations and whatnot, and I hope Eric Sprott had listened to you when he went into Pure Gold. But at the same time, I'm also thinking, the upcoming of course salesmen is something very own to my age of the internet, and oftentimes a one-liner that helps you determine who to buy and who not to buy a course from is to ask yourself whether what they're selling, like if what they're selling is that good, why do they even have to spend the time selling it instead of use it for themselves and make their money that way? And in your case, you're giving this away for free, of course, in the hopes of selling a newsletter based on it. But if it's that good, why even give it away in the first place?
It's a fair question. But actually, let me quickly jump back and mention, again, I don't give away the data, but Pure Gold was one of the top performers, not top 5, I think top 8 or so.
But the exit point was very important on that one.
Exactly. That's where I wanted to go. Remember I said that the difference between first pour and commercial production is a lot more risk. See, that's the beauty of this system, is you have a clear entry point and a clear exit point. If you sell, not just, okay, if you really love the story, maybe just take profits, go risk-free so you can't get hurt. At least do that. Please, 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 at least recover your initial investment so you can't get hurt. Because what happens after you flip the switch and you start shoveling a bunch of dirt through your very delicate chemistry set is a big question mark. And nobody, not Newmont, not Goldcorp back in the day with Eleonore, the best in the business can build a $1 billion mine and it might not work. Feasibility study is still only a study. It's only a model. Right? So that's really important. So if Eric Sprott had listened to me, he would have taken profits at first pour, and he wouldn't have had any losses when the mine fell apart afterwards, when the rubber hit the road, right? I love that you have an exit point before anything bad can happen. Okay, so to answer your question, I'm not dodging your question. It's fair enough. The literal and first answer is that when I discovered this, I was looking for something to write about in Doug Casey's International Speculator, RIP. Not Doug, the speculator.
Okay.
And this idea came up. I assigned Constantine to have a look at it. We found some exciting results, so we published. Just this idea I had. And then later, as we expanded the database and we realized how powerful this could be, it was too late. We'd already published it. And I also think that if I said, oh, I've got this new secret sauce, I've got this new, the Lobo advantage, sign up with my newsletter and we're going to make a bunch of money because I've got this secret formula that works like a charm. Well, it wouldn't take long for people to figure it out. I would be buying PPSS plays and they would notice, oh, hey, he keeps buying companies that are building their first mine. So I think, if you're going to use it in any kind of public forum, it would have been quickly reverse engineered. But even at that point, I had already let the cat out of the bag. So I just went with it. And what I've done since then is I have made a specialty of getting in front of the PPSS. In fact, I just bought a stock yesterday, a gold stock, that is not quite yet in the PPSS, but it's obviously going to do. They're waiting on final permitting, but they've got the money. They've got, everything else is ready to go. It's big, high margin, and it's on sale because the market has been stupid about gold stocks lately. So I love that. It's the chance at a high profile PPSS play on sale. I grabbed that with both hands. But anyway, so
it's probably not the same risk reward, though.
I've tried to make myself useful by being able to. I also, by the way, I think I have a pretty good track record with takeovers. Like I have a pretty good feel for what a bigger company is going to want to buy, and a lot of the happy endings for my clients have been takeovers. And I think I have a specialty in this pre-production sweet spot too, identifying what's going to become a viable pre-production sweet spot. And then there's the thing that I mentioned before. I mean, it's been very frustrating. You look at things like NPV, and there was the negative correlation with gains in the pre-production sweet spot. IRR had like such a marginally positive correlation with outcomes in the pre-production sweet spot. It was basically nothing. Size of project, there's a little bit there. Market likes big projects, but not a lot. There were plenty of big projects that didn't do so well in the PPSS. So it really has had me scratching my head, and Constantine's too, and others for years, trying to figure out what makes for those highest performers. I have a new theory now. 4 out of 5 of the top performers meet this criteria. So 80%, that sounds pretty good, but it's only 5 dots. That's not a lot of data. So I need to back test this. I've got work to do here. But that's the answer to your question. The cat was out of the bag, but I'm working on refining it. I'm working on optimizing it. And I hope that my experience is relevant to anybody who's interested in playing this system.
Getting in front of the play is one question that I have on my list here. And I do want to talk about it later on. But for a second here, I want to go back to what the strategy delivers. So if the average return is 100%, and there's positive returns in 74% of the times, why would I even need anything else? I mean, I could just buy, 100 companies across my career that have issued an FID or just a construction decision, and I'll double my money over what is a 2 or 3 year period, I believe. So, or like, what am I missing here?
Well, the individual companies will deliver their result in 2 or 3 years. That average of, it's true. So like the average number of companies that succeed in building their mine is 95% plus or minus. And the average result of that is roughly a double, 100% gain. But as you said, those are averages, and not all are good. Some of them lose money. And if you separate, so the ones that don't build their mine, those are losers too, right? So if you just, and you don't know that's going to happen until it happens, right? So if you buy before, or if you buy all of them that make the construction decision, that's where the 70% figure comes in. If you buy every single company that announces they're building a mine, historically, 70% of them have delivered a positive gain. Now, some of those are very small positive gains, and it's over 35 years. Like that's data set covers many, many years. On any given year, you've got a handful. You've got at best 5, like a literal handful. Some years, especially in a bear market, it's 1. There may even be some years where nobody announced a construction decision. Maybe, I'm not sure.
Yeah.
So in any given time frame, particularly if the market is bearish and there's only a couple people building the mine, will those deliver, 100% gains? Will 70% of them deliver 100% gains in those 2 or 3 years? Maybe not. You're taking a much bigger chance at that point in time. But the honest answer to your question is, yes, you could do this at home. Like, you do not need me to do this, or anybody else. Anybody could do this.
Well,
and hence my efforts to add value to that base case.
right. But it's also kind of turning into a nice business decision for you if I think about it, because you built this framework, and people understand it, but now you help them beat the already good framework. I mean, that sounds like a fair sale to me.
Well, and the other thing too is, okay, on any given year, if it's a really busy year, you might have 5 of these. On any given year, it's 1, 2, 3. How many people want a portfolio with 1 or 2 or 3 stocks?
I do.
For most people, the PPSS it's a corner of their portfolio. And by the way, an average gain of 100%, that sounds great. If you have 70 or 95% odds of getting a double, that's fantastic. Like, why do anything else?
Exactly.
Well, because there's so few of them. And there's still a lot of people in our space who still want a 10-bagger, Antonio. Right.
Well, yeah, what a part of it.
If by our standards, you have this messy, risky world of mining, and to just shoot for a double is seen as actually a low, not a lofty goal, right? It's a low target to just shoot for doubles in our space. People want 10-baggers. So there's always going to be a market for people who are looking for bigger gains. I'm looking for bigger gains. I'm happy to get a relatively safe double, but most of my portfolio is not PPSS plays. I especially as a newsletter writer, I can't just sit there and wait for 30 years for the next 50 of these cases to make money. I need to make money now.
Did you also run this at a starting point where you say you put $100,000 into it and then look at it in 35 years if you had just bought construction
I understand
decisions?
the question. The answer is no, I have not.
Okay.
But it's a good idea. We'll have to do that.
Okay. Because then we can talk about, is it worth it to only do that? Because if it's
I know the answer is clearly yes. Like, it is worth it to do that. But then there's basically, I guess what I'm saying is there's opportunity cost. If your whole strategy is buying 1, 2, or 3, or at most 5 stocks in a year, and then waiting a couple years and doing this for 30 years, I'm not saying that's wrong, but it would be boring to most people. It would be a very small, boring portfolio, and it would be really painful when one goes south. If you have such a small portfolio and one of them turns out to be a big loser, it would be really difficult to say, no, I've got a 30-year mindset here. I'm going to stay with the course, and I'm going to buy the next company that announces a construction decision, even if I just lost 80% on this one, right? With the endangered mosquito. That's tough. So I've thought about this before. Let me broaden it out. Blood in the streets, right? Baron von Rothschild, his famous expression, the best time to buy is to buy when there's blood in the streets. I think that's absolutely correct. But how often does that happen? A 2008 style event, there wasn't even really that much blood because the powers that be intervened. But a 1929 style event where people are jumping out of windows, we haven't seen that since 1929. We're going on almost a century. Maybe, the advent of World War II, or, there are other blood in the streets type events, but these are generational events. And, maybe long thinking Chinese masters could have investment strategies like this and actually have a family business that would pursue a strategy for 100 years. I could believe people like that would do something like that. But your average Westerner doesn't have that attention span.
But it's starting to sound personal with the endangered mosquito, by the way. I thought it was a joke at first, but I feel like you have a story there to tell.
No, not really. I mean, there's the cartoon my children watched. I forget what it was called, where there was an endangered mosquito, and it was a Disney Pixar cartoon. I'm sorry, I'm drawing a blank, but that's become an example in my mind of a silly thing that could get a mine shut down.
No, it's true. It's I was only half joking, but that there is a story, and that's good. Yeah, what this sounds fairly. I don't mean to insult you here in any case or whatever, but it sounds fairly obvious if you look at it that way, because there's only really a couple of stages of the Lassonde curve. But so if even I can understand what you're talking about, it's likely relatively easy to understand. But nobody really put a framework around this before, like, what, 6 years ago or something like. How come?
Yeah, yeah. In fact, I think it was January 2017, if memory serves, and
Hmm.
memory does not always serve anymore, but if it serves, it was January 2017 when we first published this. And of course, I guess we should also throw out there, because people will remember a different name, the marketing guys back then wanted something more exciting than pre-production sweet spot, which was not even my invention, right? It was already known that way. So they wanted something to market, and we came up with golden runway. So some people might be remembering this or might have heard of this as the golden runway,
I hate that.
taking off to the stars, to the moon and beyond, right?
I hate that. Yeah, I like yours better. But so how come? How come nobody came up with that before you did? Um,
It just, sometimes, oh, all right. So when I wrote that edition, or the headline of the lead article or the title of the edition was Hiding in Plain Sight. And that actually happens. I think it wasn't the Purloined Letter in a Sherlock Holmes story where it was like hiding, it was on the mantelpiece the whole time or something like that. So hiding in plain sight is a real thing. That's human psychology. And if you remember how the story goes, like I asked Doug, well, what do you think the gain is? He's like, oh, maybe 10 or 20%. Like everybody understood that going from spending money to making money deserves a rewrite. But it was so obvious that people just assumed that it was priced in advance.
mm,
And by the way, I maybe not doing myself or my salesmanship any favors here, but there's a very real possibility that having published this and this becoming known and other shops focusing on this, that the gains may go down. Like this, I may have undone the thing itself by taking it from hidden in plain sight to now well known.
mm,
And the example with Silvercrest is one where I think that's what happened. It was such an obviously great story that just people piled in early, and they front ran the PPSS. And so in the end, the PPSS disappointed. Now, happily, other companies have done well. And it's interesting too. It's tricky, but again, I actually studied statistics quite a bit at university. I started out studying physics. I wanted to study people more, so I ended up switching to sociology of all things, which is mostly a bunch of witch doctors dancing around. But the reason was because psychology, they had all these, hypothetical constructs. There's no way to test. How do you test a superego or an id, right? You can't put one in a box and measure it, right? But sociology dealt with people in large numbers. So you could do statistics, you could do math on their behavior. So that's why I chose sociology. So I actually did a fair amount of stats when I was in university. And so this data set, there's parts of me that like it. I defended it for being not just a small sample, but actually most of the data. So that gives me confidence. On the other hand, even the whole data set of 140 or whatever the number of companies is, I'm sorry, I don't remember the number off the top of my head. It's still a pretty small universe. Like we have most of the universe, but it's a small universe. So outliers can have a big effect here. I mean, and most of those are gold and silver companies, followed by uranium companies. Because if you make a big copper discovery that's, worth putting into production, a junior almost never builds a copper mine. If they do, it's a small high-grade one. Because, a normal copper mine is a multi-billion-dollar project, and, it's just beyond the capacity of your typical junior to build. So their exit there is not production, but a takeover, my other specialty. But what I'm saying with this is that I feel confident working with this data because it's almost the entire universe. But it is such a small universe that it is worth being careful. Right. And so like this business with the front running could easily change it because it's such a small universe.
yeah.
Or a mania in uranium, if we have a 2007 style spike in uranium, which I actually don't expect, but if that happened, well, there are several companies building their mines now, you would see let's say there's 5 new dots in the PPSS data set that are uranium companies just going nuts in the PPSS. That would materially change the entire data. The whole history of the thing would be swayed by just those 5 dots, right? So it's maybe I'm talking myself back into a job here, but I think this needs to be handled carefully. And some of them do fail, right? Some of them, I think, obviously fail. They start to build a mine and they have no feasibility study. And then either they don't build it or they do, and it doesn't work the way they hoped. There's things like that matter. Due diligence. I'm the due diligence guy, and I'm going to make a case for due diligence still mattering. And maybe you'll hire me to help you with that. Maybe you won't. But I would urge everybody not to just buy every stock that makes a construction decision. I can think of recent examples where it was obvious that this was going to run into trouble, and golly gee, they did.
I do want to talk about eventually what we're talking about here are the risks, and so I do want to talk about the risks of that strategy. One of those obviously was, what if everybody just goes and does it? Valuations are going to get out of hand. How you deal with that is by just being quicker, doing more due diligence. The case that you just made, that makes perfect sense to me. That risk is covered. Another thing that I'm thinking about, and this is really the case for commodities going higher, often is the fact that it's just gotten exponentially more difficult to build mines these days because of CapEx blowout, labor shortages, whatever, red tape, local opposition, etc. So do you think that might influence the returns on the PPSS, where the people going from construction decision into actually having built the mine drops?
It should. I mean, logically, it should. So I want a full feasibility study. I want it to be recent, especially with all the high inflation we have. You see all these companies that peddling some project. Oh yeah, we've got a feasibility study from 2012, and it shows a 50% IRR. 2012 is a whole different world, right? Even 2020, before the recent bout of inflation, is a very different world. So yes, those are things that I look at. Permitting risk, country risk. Even if you have all the ducks, you got your permits, you got your money, you got everything lined up, but the country's going the wrong direction, or there's recently been a coup in Niger. These are important variables, and if you can predict any of them, or predict is such a loaded word with me. You know how I feel about making predictions. But if the odds of a particular risk rearing its ugly head are high, then that's certainly something I want to take into account. And again, I don't buy them all. I do not buy every single company that announces a construction decision, because I think I can do better than average.
But it goes down. I mean, it comes down to it not being as easy anymore as it would have been in 2015.
If I had not let the cat out of the bag, and I had somehow managed to disguise what I was doing, I would love to have this as a secret sauce. I think it probably would help. But at the end of the day, not a lot. Oh, remember I started to answer. Sorry, I got distracted by a thought. My thought was, I think I do better than average on the PPSS. I should actually go and calculate that now. Like you asked me if I back tested it with $100,000 invested 35 years ago or whatever. This is another back test I should do. Since becoming the independent speculator in 2018, I've bet on a number of these. What is my average gain on my PPSS picks?
Yeah, I want to see that.
If it's more than the average for the data set, then I clearly know what I'm doing, or I can be helpful. I can help achieve higher gains. If it's lower, then I'll have to eat some crow here and say, okay, well, I gave you my idea. You're better at it than me. So I got distracted with that. But what I started to answer your question with the risks, oh gosh, the thought has slipped my mind. Oh, yes, I remember now. You asked if these factors, should make a difference, right, in having all the ducks in a row. And I said, yes, it should make a difference. You should have a better gain if you can pick the better ones. But at the end of the day, it's really a lot about, I don't want to say hype exactly, but expectations. Like logically, the PPSS really shouldn't exist, or that double shouldn't exist. It should be more like what Doug and Rick and everybody expected, of a much smaller gain, because it should be priced in. That logically makes sense. If the markets think about it, it should be clear who's doing it, who's succeeding, how it's going, and there shouldn't be this exponential looking ramp up to first pour at the end of the PPSS. But that's what we see, and it's clearly hype. And as you get close to first production, the press releases actually become less momentous, right? You've already got the major ducks in a line. What happens in the last few months of the PPSS, which typically, and we do have stats on this, typically the biggest gains are in the last 3 to 4 months before first pour or first plate or first production of whatever sort it is. FP works in all three cases. So 3 to 4 months, the last trimester here is where you see the biggest gains. And in that time phrase, you've already built your portal, you're going underground, or you've already done your pre-stripping, right? Your pit is already there. You've built the plant. Your last press releases are really mostly photographs of, oh, look, we've hooked up to the power grid. And oh, look, here's our testing of the flotation circuits. And, oh, look, here's our shiny new trucks going underground, right? I'm not saying it's BS or nonsense, but it's usually not like major catalysts that are happening at the end. You're finishing up, you're hooking up the wires, you're tightening the bolts, you're testing, you're making sure everything works. And that's the time when you get the biggest gains, when the least like big stuff is actually happening. So you can't ask Mr. Market what he thinks. He's not one person, but it is my view that the biggest gains in the PPSS are psychological. It's excitement. It's people see it. Oh, it's going to be a gold mine, right? People they see the shiny trucks. They get excited. People pile in. And that's human nature. And human nature is very sticky. It doesn't change over the years. So even if I've let the cat out of the bag, and even if it should be that most PPSS plays are priced in, the reality is people miss it. People don't get it. People don't get excited until they see the shiny trucks, and then it starts to become real to them. I would expect that to be actually quite durable. And our experience just in 2023 has shown cases of steep gains going up to first pour or first production of whatever type it is, even though it's now been almost 6 years that I let the cat out of the bag.
It sounds almost like being contrarian and doing, well, buy the rumor, sell the news. The rumor is, hey, we're going to build a mine, and then sell the news, we've built a mine.
I hadn't thought of it that way, but that's a good way of phrasing it.
But I'm looking at your track record on your website. Average gain 53.8%, ROI 44.6, average days held 612. The PPSS study shows better numbers. How come?
Well, that track record isn't only PPSS plays. And also, right now, as we're looking at that, we're in what would, I think, technically be described as a crappy market for resource stocks. So if you looked at that at a different time, when gold hit its first of its recent new all-time nominal highs, I think you would have seen a different number. Or let's say back in 2011, when you had a multi-year bull, not just for gold, but for copper, oil, everything. This is a counterfactual. I didn't have a track record like this back then. I didn't put my own money into all of my picks back then. And then I got banned from putting my own money into my picks. But anyway, water under the bridge. Where we are now and the fact that it's not just a PPSS record. So that was what I was mentioning earlier. I had that light bulb go off in my head. I should pull out just the PPSS picks. And I guess actually you could do that, or anybody watching this could do that. Go through those. And if you know which ones are PPSS, and if you don't know, if you click the notes, like after each entry on the track record, there's a gain and there's a little notes field, and it'll be my little explanation of why I invested in this. It'll be a bit of legwork, but you could open up and you could find every single one that's a PPSS. It'll say so. I bought this as a PPSS play, and you could calculate the average gain on that. But I'll do it for you if you give me a few days here.
Good. Yeah, that's going to be interesting to see. Also share it, and we can talk about it next time or whatever.
It's exciting, Antonio. I don't know what the answer will be. How embarrassing if I'm worse than average. How exciting if I'm better. We'll find out. We should run a betting pool.
I tell my wife not to worry about being worse than average or not, so it should be fine for you too. You're mentioning a bear market here, that we are in one. And what I'm thinking about is, and you mentioned that sometimes companies would get taken over and someone else would build the mine. But what if the company gets taken over during a bear market while you're in the process of waiting for the PPS strategy to play out? What happens? Like, can they be taken out too cheaply? That's the question.
So there's a sub question in there or a point in there, and that is the stock doesn't necessarily go straight up, or it's not a straight line from construction decision to first pour. Right? It often slumps, or it's a curve. It curves up and it steepens at the end. And in some cases, it dips below the construction decision, especially in a bear market. It probably will dip below the construction decision. And by the way, sorry, I'm getting off the side of the side point, but that's worth keeping in mind. It's not a linear thing here. But the idea that I had there, this would be another reason, is I actually don't buy on the construction decision because it's this curve that steepens towards the end, and because things can go wrong. I typically will watch it for a while, and I can often get in at a price that's lower than the construction decision price. If the markets are bearish or whatever, but the project is doing well, that's a terrific opportunity. And sorry, I've lost track. What was the question?
What if the company gets taken over during a bear market?
Oh, right, takeovers. Well, so this can happen with any play, right? Not just a PPSS plays. We call them take unders, right? If you went long at $1 and it's been a bad year and it's selling for 35 cents, and some generous larger company comes in and gives you a 100% premium to the VWAP, right? The 20, 30-day VWAP. Woohoo! 35 cents becomes 70 cents. But you bought at $1. You're underwater. Now, if the buying company is offering shares and it's a company that you think will continue rising and you might like to own that stock, maybe it's not so bad. Maybe you continue to benefit. Maybe it's even better. The bigger company has the resources to advance the asset better than the junior did. So maybe that's a good thing. But if it's for cash, if the offer's for cash, and you're locked in at a 30% loss, your dollar became 70 cents, and there is no choice. There is nothing you can do about that. So that's not just a problem for PPSS. That would be anything. I think that if you look at the PPSS plays, though, you'd probably see much less of a drawdown. I mentioned that there's this curve and that it might dip below construction decision price. Unless you're looking at a really vicious bear, though, I think PPSS plays are more insulated from the drawdowns than other stocks. Because so what makes you a PPSS play? You've got the permits, you've got the financing, you've got the decision, you've got the money in hand, and you're going to spend the next year, 2, 3 building the mine. What happens to the market during that time, in many ways, materially doesn't affect you at all. Okay, inflation turned out to be a problem recently, but the price of gold going up and down, or copper, or whatever, it'll affect your share price, but you already have the money to build the mine. It's going to be 2 or 3 years before you flip the switch on. So if the price goes up or down a little bit now, 6 months into the project, it really doesn't matter that much. Your goal is to build the mine. Your deliverable is to build the mine. And the market volatility along the way, in many ways, is completely irrelevant to that task. So I think there's another interesting question to look at this data. I'm getting a lot of ideas out of this interview, Antonio. Thank you. It'd be interesting to look at this, the drawdowns, and compare drawdowns in bear markets of PPSS plays versus other exploration and development stories. And I would predict, I don't know this, here's me, I'm making a prediction. I would predict that the PPSS plays typically retreat much less because their job is just to build the mine. Doesn't matter what's happening in the market. They've already got the money. Now, if you jump the gun and you get in before they have permits or funding, right? I can think of a high profile example right now. People got all excited about a mine build. They don't have all the money. And then they ran into trouble. And it's going to be difficult to raise the rest of the money. So a proper full PPSS play, I think, is generally more insulated from market shocks than other. Oh, by the way, not just exploration, but mining companies. If you're already mining, you need to make money. People want your quarterlies. You need to, if not deliver growth, then at least hold the line and deliver to the bottom line. So an actual mining company going into a bear market or going into the commodity prices retreating, that's much more problematic for them. Whereas for your PPSS play, it doesn't matter if they're not producing anything, they're not selling anything. All they got to do is show that they're building the mine on schedule, on budget, and everything else is secondary.
And an interesting point there was the takeover for cash versus takeover for shares, in my opinion, because I had that happen to me once. It was not a PPS; it was just a random company that got taken over. But how do you, when it is within the PPS, how do you know whether you want to keep the shares if it got taken over for shares?
You
How
would
would you judge that?
you would do the same analysis. Well, I would caveat this, but basically you do an analysis of the buyer. If the buyer is a company that I would be happy to own shares in anyway, then great. Then that's fine if they offer me shares. If they're not, generally I will take the money and run. If I get a takeover offer from a company that, let's say, I can think of one now. Actually, there's one now in my portfolio, or did I sell it yet? I don't remember. No, I haven't sold it yet. There's one in my portfolio now, has a takeover offer. I'm not interested in owning shares in the buyer because of political risk. There's nothing wrong with the company. The company's making money, the buyer, right? But it's just not a company that I want to own. And buying this asset doesn't change that story enough to make it a company that I want to own. So I'm looking to exit before that deal closes, even though it's not for cash. And by the way, if it is for cash, usually the share price of the company being bought comes up to within a very little arbitrage window of the cash offer price. And at that point, unless you're likely to get a competing bid and have the glory of a bidding war, you might as well just take the money and run. So back to my caveat. So generally speaking, it's quite simple. If I would like to own the company that's buying me or my company, then I'll ride along and take shares in the new company. If I don't want to own that one, then I'm looking for an exit. The one possible caveat would be is if the acquisition was a real game changer. Like if this one that's doing the buying, they have a portfolio of A, B, and C, and all they need is D to really perfect this. Maybe it's a vertical integration story, right? They just need the mine to perfect this larger business, or maybe it's an area consolidation play, or maybe the asset that's being acquired includes, an operating fully permitted mill with tailings capacity for years, and the other guys, they have all these deposits, but they don't have a place to put the mill. Something where the sum of the parts is greater than the parts separately, right? Where 2 + 2 isn't 4, it's 5. There are cases like that, and they're somewhat rare. But in a case like that, that could change my view. Like maybe I didn't want to own that company that's doing the buying, but I can see the synergies here unlock enough value that the new larger company is a company I would want to own. So I actually don't think that's ever happened. I can imagine it happening, but I don't think I've ever actually experienced that yet in my career.
But is that pretty much the only moment where you would do sort of a checkup to see, oh, do I still want exposure to the asset with this new operator? Or do you also do like periodic checkups to see, are they on time and on budget? Do you check with that?
My mind's going two ways. I'm not sure exactly what you're asking. But yes, if the PPSS story goes off track, that is a reason for concern. So, the plan is to buy sometime around the construction decision, especially if things seem to take off well, especially if you get a lower price, and to sell at either first pour or, in rare cases, at commercial production. That's the plan. But if the plan goes awry, if they run into permitting problems, or they start building tunnels into the mountain or whatever, and they flood with water faster than they expected, it's a big problem. Or any number of things. We'll leave the poor mosquitoes out of this one. If something goes off the rails, then yeah, I would. In most cases, I would expect to exit early. As a newsletter writer, I have to give my readers first dibs on that, and so sometimes it takes me a while to pull the trigger. But yeah, if the basis for speculation on any speculation goes away or is damaged, that is a reason to consider selling. There was something else in how you asked the question that brought up another thought, and it slipped my mind. Anyway,
that was my question. Like, are there periodic checkups where you can tell, are they performing above par or subpar?
Okay, right. So yes, I mean, that's not a schedule thing. It's not like something I do every quarter or whatever. That's something that I would look at every press release, every encounter I have with that. And not even just the press releases, country news, right? If something happens in the country, that changes the potential, the risk, or maybe even the benefit, good news or bad news from the country. I want all data all the time. This is my life. I live, breathe, eat, sleep. This is all I do, which is why people hire me to do it, or help with their due diligence, right? They have a life other than this. This is all I do, right? So, but I'm remembering the other thought, and that is, checking up on the assets after acquisition is an interesting thing. And the answer is, it depends. If it's a mid-tier or if it's another junior, a merger can really be a game changer. And so it might even be like this. There are plenty of times where I see stories where the buyer and the buyee, or if they're somewhat equals, the mergees, they're both thumbs down in my take. And two thumbs down together generally doesn't make a thumbs up for me. But if it looks like there might be synergies, then yeah, I'll monitor that. And if the two companies together now merged can put, say the mill that this one has and the deposit that this one has, put it together, and they're making money and there's still upside there, then yeah, I'll reconsider that. So I try to keep an eye on all this stuff. I have a team now, as you know, we're tracking 700 plus companies now. But that's pretty rare. Usually it's a bigger company, and with a major, if Barrick or Newmont buys your 1,000,000 ounce deposit that's going to produce 100,000 ounces a year, I mean, that's too small for them. But if that happened, that would almost be immaterial to them. And that their level of production, if they're producing 5-8 million ounces a year, whatever the big boys are doing this year, another 100,000 ounces doesn't make that much difference to them. And even really big projects, 10 million ounces projects, it's rare that you have an output rate that's over 500,000 ounces a year. So if you're Barrick producing at around 5 million ounces a year, which is down from recent years, even 500,000 ounces a year is only 10%. So it's great. I mean, if you can increase your output 10% while gold prices are up, I just said gold prices, while the gold dollar exchange ratio is up, that's great. But it's not a game changer. It's 10%. So, you get a big company buys some high grade asset I'm really excited about. And usually it just sort of disappears into the bigger company and it doesn't matter that much anymore. If it's a mid-tier or a smaller company, it matters more. And then maybe if you had something on the scale of a Pebble or a KSM or something like that, or Recce Dick for Barrick, if you have something that monstrous, sure, that would make a difference. But projects that big, very few of them, most of them have permitting problems, political risk problems. They're going to take many, many years to bring online. So I was going to say it's rare, but I can rephrase that and say I cannot think of an example where a company has made an acquisition like that, and I decided, the large company, and I decided to buy the stock to then see how this world-class asset was going to change that story going forward. It's just really tough to move the dial when you're that big.
That's it gets me thinking to look at some of the data again of what happens during bear markets in that case. But this is all sort of around the topic of how not to get burned on this whole thing. But maybe we can also talk about how to make sort of the top decile of the strategy. You just told me that you don't necessarily know because it's not valuations, like it's not EV to MPV or something like that. But I mean, there should be, so it feels like there should be something telling you there should be, or is it all random? Like who performs in a top decile?
The random would be easy. That would be and a defensible answer. Like it's just a fluke that there's this. It's five. There's 5 dots that just stand out from the rest of the distribution in the PPSS data set. And that's, 5 out of 145. It's enough that you could just call it noise. But it's just visually striking. If you look at a dot plot, not the Fed's dot plot, but a dot plot, a scatter chart, right? There's this cloud and there's some, lumps in it. And then there's this group up over here. And it's so distinct that it's just hard not to think that there must be a reason for that. And you know what? maybe there isn't, maybe it's noise, maybe I never find something. But if I can figure this out, Antonio, if I can have 100% gains 70 to 90% of the time be my base case, and I have a higher shot at 700-800% gains than normal, that would be a thing of beauty. That would be awesome. But let me throw another thing in here for this. Like, of the top five dots, one is uranium, two are silver, one is gold. So it's not just gold. And one is copper. The last one is copper. So it's not just a gold thing, right? You think gold goes nuts or whatever. It's not just a gold thing. It's not NPV. It's not IRR. It's not just size. Remember I've said that I think in general the PPSS, the final big ramp up and the main driver is psychology and excitement, hype, if you will. There's no accurate way to measure this. We tried, actually. I had a theory. One of several theories I tested for explaining this group, this outlier of top performers, was promotion. How do you measure promotion? Well, you could look at, many of the companies don't really disclose this. You can look at the financials and you could assign G&A, but you could have G&A be presidential salaries and stuff with little promotion. Or you could have people that, really tighten their belts, live on a shoestring, but they put serious money into getting their story out. And you wouldn't be able to tell if they don't break down the G&A. And most companies don't. They really, promotion is sort of a dirty word in the business. And I think most companies go to some efforts to not necessarily lie about it, but not make it obvious how much they're spending on promotion. So we also looked at, say, press releases. Like, how many press releases are they putting out? That could be a sign of promotion, right? They're every week they're putting out more photographs of, here's our shiny new truck, here's our shiny new computer, here's our new water cooler, right? The water cooler is like the mosquito. That's my example of a bullshit press release. Oh, we got a new water cooler. So we did that and didn't find a correlation either. I still have a strong sense that promotion, an exciting story, well, what makes for excitement? Well, promotion helps add to the excitement. It makes intuitive sense to me that promotion contributes to the top performers. So in the PPSS, instead of promotion being a dirty word, promotion might actually be a key for top performance. But I've not been able to measure this. I haven't found a way to show this. I have not found any statistically significant explanatory variable that I could say this is promotion and it had that effect. It's just my sense that it should be so. Yeah, interesting times. And I'm not going to tell you what my new theory is, but if it turns out to be true and I can keep this one to myself, then I will let you know that it's working.
Fair game. I have a personal problem with the promotion thing because it works, but sometimes the people leading the company are almost too sleazy that I don't even want to deal with them. I understand that the stock is going to go up probably, but I almost don't want to deal with it. It sounds bad because we're in this to make money, so just make the money basically. But at the same time, I'm kind of afraid of the people who are over promotional. I don't know if I'm making any sense here.
Yeah, no, that makes perfect sense. And I will say, I am willing. I must be a mutant or something. I just don't feel FOMO. I just don't. I'm perfectly willing to miss opportunities to leave money on the table. And sometimes something like that will happen, and yeah, they promote the heck out of it, and the darn thing goes crazy on nothing, right? On a grab sample, right? Or the intention. Or target, they'll outline a geophysical target, right? And the joke, the geophysicist, the geologist asks the geophysicist where the deposit is, and the geophysicist says, where do you want it to be, right? Because they can interpret the data any way you like, right?
Yeah.
So I've seen stuff like that where coulda, woulda, shoulda. You knew that they were going to promote the heck out of this thing, and darn it, they did. But if you jump into something like that, and it turns out to be nothing, right? Or they run into problems and things, and you knew it was crap to begin with, and you pinched your nose and you jumped in anyway, and then you end up losing money. To my mind, that's much worse. This is hard. Like you asked about how not to lose money, how,
Mm.
or you didn't phrase it that way, how not to mess up. Betting on companies that you have grave reservations about is a way to avoid problems. Like, okay, you may miss out on some extraordinary promotional success, but if you don't trust the management team and you make a systematic approach in your speculative investments of not betting on teams you don't trust, I think you will do better than if you just throw darts at everybody.
Hmm.
People do matter. And good people, if there's a setback or a problem, they'll fight through it. They'll find a solution. People that are just there to collect a lifestyle paycheck, that they'll let you suffer the death of 1,000 financial cuts, and eventually they just go start another company.
Hmm. But in the end, still, it's speculation, right? I mean, in your track record on your website that I have over here, I see names that I wouldn't want to touch because of the people behind them. Some of them you would probably know who they are, but you made money on them because it's a speculation.
Yes. So there's that. There's one right now out of a couple dozen in my portfolio right now that I really have issues with the way the management promotes the story.
Hmm.
But, they're making money, right? Like if the bottom line is the bottom line, like I was willing to go there. Like if it had been a pure exploration play, I probably wouldn't. My concerns about management's hyped up promotional style could easily, or I'm thinking back, I would have been a deal killer. It was because even though I don't like their style, but they're delivering to the bottom line and I see the growth, like they can exaggerate or whatever, but the deal's the deal, right? The new mine coming online, it either it is or it isn't. You can't make that up.
Hmm.
Right? So if those pieces are there and they're making money and I see the growth, I can say, that there is right now in my portfolio is an example of a company where I really don't like management style, but what they're doing is working. And so I'm willing to speculate.
Hmm.
So it's not an absolute no-go thing for me. But if I'm on the fence and I don't like management style, no, why go there? Or if I have multiple choices, I've got 5 stocks on my radar right now. I'm going to pick the ones where I trust management.
That's right.
Before I go anywhere else.
And this also might be a good point to talk about valuations, because if you see that Robert Friedland is trying to build a mine, well, you
Yes.
trust him because he's done it
Yes.
before. But oftentimes these deals are
Yes.
already overvalued.
That's exactly right. So I mentioned before that I don't buy every single PPSS play just because it's a PPSS play. Valuation would absolutely be one. If the company has some, market darling of a discovery and everybody loves it, everybody's excited, and the company's already being given all of NPV even before they build the mine, but forget it. Maybe I can actually, there's one case I can think of. I think I can say this because I sold the stock already, was Boss Uranium, where the IRR was so high and it was such a relatively easy thing. It was really a refurbishment more than building. So they had permits, they had money, they had a very high IRR, they had the type of story that seemed like it would excite the market. And by the way, this is a recent 2023 story. And unlike Silvercrest, it did deliver the typical PPSS, very steep rally up into the end. And I'm not recommending for or against the company now, but I got to the end of my pre-production sweet spot play and I sold. But a reason why I bring this up is because the market valuation of that stock, even when I bought it, was more than the NPV of the project by the proven or probable reserves that were in them. And the reason for that is because there was this huge land package and they have all these resources, but only a small amount were drilled off to P&P that were in the study. So the value of that subset of the overall resource, and you could say, oh, well, those other ones weren't proven. They weren't proven or even probable. They were merely measured and indicated or inferred or whatever. Yeah, but it wasn't some fly-by-night junior that defined those resources. So even if half of them weren't there, the other half that were there meant that the NPV was really wrong. I mean, it was just based on this one small subset. So you knew that the mine was high margin, or the study said the mine was high margin. And you knew that it was based on only a small part of the asset base, the actual, resources in the ground. So I was comfortable saying, okay, if that resource is 1/5 of the overall resource or likely resource, and the company's trading above NPV, it's not 5 times NPV. So there was still a value proposition for me there. Am I making sense, or am I throwing too many
Yep.
numbers out?
No.
Right. So, but that was rare. In most cases, is not like that. That what's in the study is most likely what's going to be the mine. There may be upside, but maybe it's all still inferred, or it's not quite so likely. And by the way, this is actually one of the reasons why, instead of just taking profits in this case, I sold the stock entirely. I exited the position. I bagged the win. It was like a triple or something. And I just took my money and moved on. And part of that was because of this, like, okay, I see the potential value of these resources that are not yet in the mine plan, and they're working on it. They're drilling this other stuff, and they're having success. But they need to continue to have success. It is an if and not a when question. Like that, the rest of those pounds need to be upgraded for that valuation to keep going higher. And on top of that, not to beat up on the company, it's not just a simple refurbishment. They added these, a new filtration system. There is new technology that they're employing that they hope to do better than the previous operators of the Honeymoon Mine achieved. That's another if, not when question. It's not like they invented some new technology, but it's new to this mine. And all mines are different. So you really don't know until you flip the switch what's going to happen. So there's technical risk here, execution risk here. There's a valuation issue here. None of this will matter if uranium goes to $140 again. That stock will keep going. So I am not poo-pooing that stock. I'm just explaining why, and in answer to your question, like these considerations, like you talked about updating and keeping up and so on. And in this case, there is a clear reason why, or reasons why, I had a big win. I'm just going to take it, and then I'll come back to it. If the mine works as advertised, and they keep drilling off more of these pounds that justify a higher valuation, well, then I can look at it again, not as a PPSS play, but as a growth story, a profitable producer with growth. And I might buy again or not. We'll have to see if they cut the mustard.
But it's also uranium, and uranium has increased a whole lot. And so when you mentioned that, was the study done in 2020, the cost assumption was different, but at the time, the price used for the study was also probably different than the price that is right now. So that's something worth checking as well, just to see if the EV,
Yes.
MPV
Well,
is
and
still
also, I mean, they started the refurbishment like a year and a half ago or whatever. So if the study was 2020 and they started, if the construction decision was in 2021 sometime, well, that's not so bad, right? If you're making a construction decision now, today, almost 2024, based on a 2020 study, I'd say that I wouldn't even count that as a study anymore. I would not bet on somebody doing that. I would want to see a new feasibility study after the inflation we've seen in the last few years. And even using the word inflation isn't quite right, because at least officially, we're looking at, at worst, 9% inflation at the highest rate of increase. And the cost blowouts we've seen are like 100% cost blowouts, like, that sort of thing, or 50% operating differences because of fuel costs and so on. So it's not just inflation. It's a specific hit to the mining world in the post-COVID environment that has drastically changed cost assumptions. And so I think in that context, it pays or it will pay for everybody to be very, very cautious about anything other than an up-to-date feasibility study. And you know what? Sometimes a company comes out with an updated feasibility study, and the NPV is usually the NPV is higher because of higher metals prices, but the IRR may be lower because of higher costs. And the market punishes these companies. Oh, the IRR is not as high. That's a much more credible study. I think that's short-sighted and a mistake. A company that comes out with an updated, solid with current cost numbers study that still works, is robust at current prices, I think that's a much more, I'm much more attracted by that value proposition than I would have been otherwise. And also, if I'm right about this, again, it's not just general inflation. The problem hasn't been, 5, 6, 7, 8, 9% inflation. It's been huge cost blowouts. If I'm right about that being an artifact of the COVID shutdowns and not being able to get equipment and not having people and all that stuff, well, that pig is working through the python. Right? We're not in lockdown mode anymore, and we're not going to be in lockdown mode. So I don't think we're going to see the same type of cost blowouts going forward that we saw in recent years.
Hmm.
I'm not saying costs will go down. I'm not saying that, inflation isn't a thing. But I think at this point, it would take real incompetence to miss your CapEx by 100%.
What about some of these obscure metals where they have these wild swings, sort of your uranium, vanadium type of thing, where the company is going to do a study using an above spot price valuation because the spot price is already under the incentive price for production. So it just doesn't make sense to even put the current spot price in there. So they go for double spot or 50% above spot. How do you look at those?
Well, there's not a simple answer here. I can justify it in some cases. Let's take uranium a few years ago. Like everybody was using $60, $70 uranium in their studies. And at the time, uranium was $30 a pound. And you say, well, that's ridiculous. It's way above spot. But it's not so ridiculous because basically what the whole industry is saying, it's not just one fly-by-night junior trying to pull a fast one here, right? The whole industry is doing it because none of these mines will get built at these prices. Nobody is saying, oh, well, we can make money at $30 uranium, besides the Kazakis.
Not anymore.
Not anymore, right? But back, so it was realistic because these mines weren't going to get built unless uranium prices went up. Now you could argue about what was a reasonable price to use in the study, what should have been the incentive price. And it's interesting that it's kind of worked out that those prices were not a bad call. When uranium started hitting $60, $70, people started building those mines.
That's right.
So that's one case though, and that makes sense. That was defensible in that case because it's like we're just not doing it unless we get. And they didn't, right? They sat on those projects for years and years until the incentive price came, and now they're doing it. So that's fine. But if you have a copper project and you're going to put a $4.50 copper price assumption in there, when A, we're not there, that's above spot. B, we're going into a recession, and copper prices might go even lower before you can get there. Right? And you could argue, okay, but over the next 30 years, this is a long life mine, and over the next 30 years, it's probably going to average $6 a pound. Well, maybe it will. But over the next 30 years, your costs are going to be higher too. So basically using a price for, with the exception of something like that case with uranium, where the mines just weren't going to get built up. In a normal context, it's never acceptable to use a price above spot. Now, if it happens to be that when you commissioned the study, the prices were, you based your study on this, and then it happens to be that the day that you go to put out your press release, prices drop below that level, well, there should be a sensitivity case in there, and you should have a, plus or minus 10, 20% variables, and you have the numbers there. You can tell your lawyers to rewrite the press release and use the minus 10% case or something like that. Make that your new base case. Basically, I see no excuse for that. The one reason that's been given, and I think it's quite fallacious, is that the industry standard in most metals for the decades I've been in the business is that you use a 3-year trailing average. And a 3-year trailing average is a conservative price estimate. And at least for smaller mines, with a 5, 10-year mine life, that's not so bad. For a 30-year mine life mine, I'm not sure. But okay, let's go with it. 3 years trailing average is a conservative price estimate. In most of the time, you're dealing with, inflation or other factors. Over time, the commodities fluctuate, but they generally go up, right? They go up and down, but generally they go up. Everything that we look at, it's more dollars per pound or ounce than it was in 2000 or in 1980 or whatever. Generally, things go up over time. So a 3-year average is going to be lower than current spot in most cases, right? If if gold was $1,000 3 years ago, $1,100 a year ago, is 1,300 now, and the average is right here in between. Your average is less than spot. And that's the case most of the time. And so 3-year trailing average is the industry standard. It's defensible. It makes sense. But if you're in a bear market, and this happened between 2011 and 2015, I would see companies put out feasibility studies on gold projects with gold prices way above spot. They're using $1,500 gold in a $1,300 gold environment. Actual gold dollar exchange ratio today at the moment the study was released. And they're like, well, that's the 3-year average. That's the standard industry number. It's just, the conservative 3-year average. Well, but it's not conservative. It's over spot. How can you, with a straight face, go to the market and say, oh, here's our feasibility study. It's, with a gold price assumption that's 20, 30% above spot. That's ridiculous. It's not conservative. It makes it an if, not when question. It adds to the uncertainty. You have to see something that hasn't happened yet. The gold dollar exchange ratio recover to that price level. And if you had done that in 2014, 2015, 2013, any of those years during that bear market, you had used that price, things would have gotten worse. Your project would have become more unrealistic and shareholders would have lost money.
I think a general rule of thumb is what you gave me last time, which was no discount, no deal. That's sort of the mentality that I got out of it. And if people are wondering what does that mean, what are valuations, I would direct them to that video we talked about, EV to MPV and all these beautiful things. But yeah, I mean, is that the holy grail, valuation and management? If that checks out, you wait for a construction decision and you go in.
There's, we talked about promotion before. There's an alternative. Well, there's a couple alternatives. One is to bet on the jockey, not the horse, like really literally. You're going to bet on everything Ross Beatty does, everything Bob Quartermain does, everything Frank Justra does, everything Robert Friedland does. Just buy them all. Doesn't matter what the valuation is. I haven't done the math on this, but I think if you did that, well, it's kind of like the PPSS thing. It's 35 years. It would take a while for this to work out. But if you did that over the decades, I think you would probably make money, regardless of valuation. Now, most people don't have a multi-decade time span. And if you buy something that's overpriced because it has the Friedland name or the Beatty name or whatever attached to it, and it doesn't work out, you can get hurt. And you will get hurt, especially in a bear market if it was overpriced to begin with. So even those golden boys, not all of their picks are successful. And if you can't buy all of them, and if you don't have a multi-decade time frame, that can still be dangerous. So that's one thing. We're looking at. I'm getting distracted.
Well, I asked about besides valuation and management. What else?
Right. So I was saying. So there's that. There's promotion too. If you get hold of a story that or you see their budget, they're going to get promoted. That can work. There's market timing. If you actually think that gold is bottomed or uranium is bottomed or whatever, and you just time the market right, then that can work even regardless of valuation. Or if you pick a geopolitical event in advance, if you knew that Russia was going to invade Ukraine this time around, you thought you knew that, you could position yourself regardless of that. But my view is that all these things are risky. Nobody really ever knows, and even Babe Ruth strikes out sometimes or comes to the end of a career. Right. So my view with the jockey thing in particular is I want to bet. I'm happy to bet on a great jockey, but I also want to see a horse. The horse has to exist, and it needs to not look like it's headed for the glue factory. I want a great project, and that means valuation, as well as a great jockey. So I actually call myself a value speculator. It sounds like a contradiction in terms. I also call myself a Christian atheist because I think the carpenter of Nazareth taught some wonderful lessons, and that makes smoke come out of people's ears. But let's stick to the mining world. I consider myself a value speculator. It's very different from being a gambler. It's something Doug Casey taught me. You're not just tossing the dice. If you want to put the game as much in your favor as you can, you don't want a 50-50 chance. You certainly don't want less. You want to put the work in, the due diligence, stack the odds in your favor as much as you ethically can. So I'm looking for value. If there's lots of ways that you could make money, but in my view, they're all riskier. And if I've got value on my side, I think the downside is much less.
I do understand you being a value speculator. I consider myself a communist when it comes down to my wife's money, and when it comes down to our own money, I consider myself a libertarian. But no, good point. It's but people also change, and that's a point that Rick Roll makes, is that when you're betting on the jockey, you want to make sure that they're going to be riding a horse and not all of a sudden become a race car driver, meaning going into a different direction, doing something they haven't done before, and yada, yada, yada. And all these things still apply. So that's a point that he makes, at least.
Another way of putting this, and I've written about this before, is, I have an eye towards including potential 10-baggers or better in my portfolio. But that is actually not my goal. It is not my stated goal that I'm shooting for 10-baggers. Because to consistently go for that embraces a much higher level of risk. I am perfectly happy with doubles, triples, the occasional 5-bagger with a much lower risk profile. So when you shoot for 10-baggers, and you've heard Rick and others tell, I'm not throwing Rick under the bus here. This is what they say. You have to understand that you will lose money on most of your picks. More of your speculations will lose money than the ones that make money, but the big wins will amortize the losses, to use Rick's word. But Doug says something similar. Many of my mentors say something similar. You have to understand that if you're going to be a speculator, you're going to lose money most of the time, but your big wins will more than make up for it. And the average works out to a nice gain. I'm just not wired that way. I hate losing money. And so if you look at my track record, which you've had up, looking at it, I've lost money on some, but I make money on most of my picks. I don't just make up the losses with a few big wins. It is my conscious stated goal to actually win most of the time. And I'm okay with fewer 10-baggers if it also means a lot fewer big wipeouts.
You remind me of Will Smith. He says something along the lines of becoming famous is awesome. Being famous is kind of cool. Losing fame is the most painful thing in the world. And so you're kind of like him, but for money. Becoming rich, no, that makes sense. Okay. What else? I mean, I've got 2 pages of notes, so I'm kind of lost here. But I think we went through a good chunk.
So we've been working through the Lassonde Curve, and the PPSS is that last ramp up. And I mentioned at the beginning of the talk, but it's probably a good thing to cap it with, is, pay attention to the end. There's a reason why I sold Boss, that we talked about it, at first production rather than commercial production. Once they're starting to pull uranium out of the ground, well, now all these things that don't matter while you're building the mine do. What does it cost? How's it working? What are the recovery rates? What's the market doing? All that stuff. Remember we were saying that a PPSS play can be insulated from the markets, because if they're building the mine, they've got the money, they've got the permits, they have only one goal or one task, and that's to build the mine. And that will take them 2 or 3 years. So what happens in between doesn't matter. But the producers, it does matter. And this, if you're a new producer, you've never done it before, you have to show that your study was right and you were right and everything is going. So there's a great deal of risk there in general. And then even if it's successful, you have the question of, okay, but now where's the value added? Let's say you build the mine, the market adjusts, you get your PPSS win, yay, woohoo. Okay, we've built the mine, now what? If you're a single asset company, you built the mine and you're going to produce 100,000 ounces of gold for the next 10 years, and then you're done with your 1,000,000-ounce deposit. Well, then what? So if there isn't project number 2 or the next zone to be developed, or phase 2, or if there isn't, a bunch more veins that are being drilled off, or something that, it's clear, visible. Okay, so now we've got a producer that's delivered, right? They're making money, and here's the upside. Here's the value added. Again, I'm still a value speculator, right? So it's a very different question, and you need to. it's not enough at the end of the PPSS, as you leave the Lassonde curve. It's not enough to say, okay, yay, they succeeded. Now you have this new question. Okay, what's my new value proposition going forward?
What would that like? It almost sounds to me like there aren't that many. It sounds to me like the finding a good risk reward here is more difficult than finding a good
I'm
pre
not sure I
PP.
agree. I mean, it's not always terribly clear. I mean, we talked about, for example, Silvercrest, and they're one, and I'm really not flogging for or against this company. I'm not telling anyone to buy the stock. That it's not particularly cheap. They did actually have some disappointments after first pour, and they had to redo their mine plan. Now it's high grade enough and it's big enough that they still make money, but they actually downgraded the mine after they built it. Again, that's risk. After first pour, there is more risk. But on the other hand, to this question, they've got like 23 more veins that they're not producing. And they keep finding more, and they're high grade, and maybe some of them are thin, maybe some of them will never be produced, but there's a lot more upside. And they have another project that they're drilling on. So there could be Silvercrest 3 along down the line. We'll see, who knows? Again, I'm not telling anybody to buy on this basis, but I am saying that, okay, they built the mine, they're making money, and you can make a case for where the value added would come from. Another example I might give, and again, I don't own the stock, it's still a going concern, but would be Lundin Mining. And I'll bring it in, sorry, not Lundin Mining, Lundin Gold. And I'll bring it in because, they had this huge world-class high-grade deposit, right? 13 million ounces at 13 grams per ton or something is, I think, the original estimate, the original inferred estimate. But then you go proving it up, and there's different domains. At the end of the day, the proven and probable reserves that they built the mine on were like 4 million ounces or something, like less than half of the known drilled off mineral endowment. Okay, some of it's still inferred, and they went for the more consistent part, the easier part to mine, and some of the other stuff was more scattered around. It would be more expensive, more development to mine it. So I understood why they focused on this. But it had a good margin. They raised the money, they built the mine, and all that other gold was still there, Antonio. It didn't go away. Sure. It made sense to build the mine on the highest margin portion of it. It had a compelling NPV and an IRR. They built the mine, and all that other gold is still there. And now you have an underground mine from which you can drill off extensions much more close, much less expensively than from surface, in much finer detail. You can understand it better. And you don't have to build a mine, so you don't have the capex. Your threshold for bringing in new stopes, bringing in known ounces is pretty easy. It's not such a big hurdle to leap over. So again, I'm not telling anybody to go buy this stock, but I'm saying there are plenty of cases I can think of where the mine is built based on this like starter scenario. And the what next, we just talked about Boss. The what next is right there. Like we already know where these pounds and ounces are. There is something of an if rather than when question, in that they need to be drilled off and they need to be upgraded, but you don't have to discover them. You know where they are. Or, in many companies, they're multi-asset. They'll build their best mine first, but they'll have the other ones there and they may bring them along.
A lot more qualitative than it is quantitative versus the PPSS, though. And then I'm thinking, if I have another opportunity within the PP, and that's a big if, because as we discussed earlier, that they're not always there. But if I have another opportunity in the PPSS, why bother with a company that's already completed?
Absolutely. Well, and the answer to that is you only get a couple of those a year.
Yeah.
Right. So, but this actually brings up another key point. A company can only be a PPSS play once. If they're going to build another mine, they're not a PPSS play. They're a producer that's now adding production. That's a very different thing from that transition from spending money as an explorer to making money as a producer. That re-rate is different. And I'm not saying that adding production doesn't matter. If a profitable producer doubles, triples, whatever, greatly increases their output, sure, that's material. The stock should move on that, but it's not PPSS.
That's right.
So existing miners that build a new mine, that's not a PPSS play. It has to be a company making that transition from exploration to production.
What's the second best? Would it be prospect generators for you, or
Prospect generators require a lot of patience, and they require a basket approach. You never know when one of those guys is going to deliver, and it often takes many years. So I do like it. If I had the patience of a Baron Rothschild and I could wait for blood in the streets, buying a bunch of prospect generators in 2015 or something like that would, be great. But no, I guess my other favorite strategy, I think we've talked about this before, is what I call success in progress. And that is, rather than trying to predict who's going to make a discovery, jump on the bandwagon when they make a discovery. And the error here that I'm trying to correct is that people think of the discovery as the discovery hole. Like that first hole where they hit 100 meters of 5 grams. Woohoo, fantastic discovery. The stock goes nuts, right? Yeah, that happens. I am deliberately missing that because nobody knows who's going to make that discovery. But the error is that people think, well, that's it. The stock goes nuts in that discovery hole, and then you go in the boring engineering phase. No, not even close. That first hole, you need a confirmation, you need a scissors hole, you need to do something, step out, drill again. And then from there to delivering a first resource estimate to the market, you're talking months of drilling. Maybe years sometimes, right? If it's still open, you keep hitting, you keep stepping out, and you haven't run out of mineralization. Why do a resource estimate? Keep drilling, right? So the error is thinking that the first spike at the early part of the Lassonde curve is one drill hole. It's never one drill hole. It's a process. And if you jump on that bandwagon after you see predictable results, like, sometimes they drill it's a one-hit wonder, right? And it doesn't pan out. And you see a little spike and there's no Lassonde curve. The stock goes back to penny stock hell and you never hear from it again until, management changes the name and buys a new asset or whatever. But if it's going to be a company that makes it through the Lassonde curve, that first part of the curve is usually months or years between that first discovery hole coming. You have a theory, it's a porphyry or it's a vein or whatever, and it starts predicting, and you start drilling and you keep hitting. So once you start seeing that predictability, there's time to profit between there and the first resource estimate as a rough guide.
What it sounds to me like you're describing here is sort of a PEASS, the pre-PEA.
Well, let's not get carried away. I see it as separate. I really do, because it's the discovery process. And not all discoveries become mines. There's sometimes you make a great discovery, but it's in a politically challenged place. It's never going to get permitted. But you know what? Again, markets are irrational. They're not efficient. And, an exciting discovery, even in a very difficult jurisdiction, will still go nuts. But you'll see. I mean, if they just keep hitting smoking hot drill holes, and it's in Bolivia or, I don't know, or Mali or one of these places now that has a coup every three months or something, the share price will respond to that discovery, even if it may never become a mine. So, and the permitting, the boring engineering phase can last a long time. They can fail. They can never get the permits, right? Yes. So you can't assume that a discovery is leading to the pre-production sweet spot, but you can make money on it. And my point is, and again, it's like I was saying earlier, it is explicitly not my business plan to try to hit all 10 baggers, or I'm not aiming for 10 baggers. That's not the goal. My goal is a balance of risk and reward. And if I miss out on that double or triple on the discovery hole, but I get 3, 4, 5 times my money as they drill off a world-class deposit after the results are becoming predictable, I'm okay with that. Because that I can see it happening. It's not entirely a when question, but it's not entirely an if question either. By the time I jump in on success in progress, it's in progress. I can see it's happening now. And that's a reasonable trend to speculate on. And by the way, There's a free report. It's not a report, it's a document. But if you go to the website, little self-promotion here, if you'll forgive me, Antonio, if they use that little magnifying glass up there, click success, and you'll see a link to the success and progress article, and that'll explain this. We also talked about takeovers. There's a free report on takeovers, and there's also a free download on the latest version of our PPSS research.
There's going to be people listening to this and thinking, because you said that it's easy to do this, and then you have to go and look for success on your website, and then you're going to get it sounds like an infomercial, as I said at the beginning. We've come full circle. But
so we also said with the PPSS that, I've let the cat out of the bag. Yes, you can do this at home. I hope to still provide valuable input. I hope you'll hire me as your due diligence guy. But if you want to give it a go by yourself, the essentials of the idea, Antonio's going to make a joke about, oh, even I can understand it, so it must be simple. But I think more highly of Antonio than that. So I'll just say that the finding is robust enough that you don't need me to do it. It's the plain truth of the matter. Right. I think I do other things besides that might be helpful, of course.
The triple P double S is where people need you.
Yeah. So I guess, one of my attempts at keeping a job here is to say that I think I have a pretty good track record of seeing which projects are, legitimately have a chance of becoming a mine and will become PPSS plays. And so the newest stock I just bought, that the headline of the alert that I put out to readers yesterday is bought pre-prediction sweet spot. But I'll only add one P. One more. No, 3 Ps before is too many. I'll add one more in this case because it's a real thing, but that's enough.
This was great. I've got a couple of more topics that we could make a whole podcast on, but yeah, thank you so much for investing your time with me, Lobo. It's www.independentspeculator.com. And yeah, thank you so much for doing this.
Well, thank you for walking through the Lassonde Curve with me. It's been fun.